Thanks for being here. So my name's Erwan. I've been dabbling in the space since about 2017. I've got a traditional finance background. I was doing sales and trading at banks and brokerage firms before moving on to crypto full time. I've been at Bakkt for 2 years. And what the company does is basically issue tokens which track traditional assets like the S&P 500, US T-bills. We focus on publicly traded assets. You can think of the major assets in the traditional world. Our thesis is that if they matter in that world, they should also matter in the on-chain world. So I think a few people already mentioned this, but we probably need a better name for those real-world assets. Some people have been shilling off-chain assets. I think Mark Zeller was pushing that one yesterday. Robert Leshner at Compound was pushing for traditional assets. So whatever it is, but yeah, I don't want to offend anyone. Obviously, crypto native assets are real. But please don't be upset if I accidentally still use the term real world assets. It's still quite sticky. So in this presentation, I'll cover a few topics: the landscape, current landscape, technical challenges and regulatory issues that we faced when tokenizing those traditional assets, and decentralization in the context of those assets. So I'd first like to get back to the demand side and make DAO being a clear case study here. At one point, it held close to half of its reserve in USDC. When you're holding USDC, synthetically, you're holding UST bills, because that's what Circle does with your dollars. They invest in those short-term T-bills. But with USDC, you're not getting the yield, and you're adding counterparty risk. So Maker, rightly so, wanted the yield, and they built, off-chain infrastructure to get direct exposure to UST bills. Maker was able to pull it off because of its size. It's one of the most prominent player in our space, and they're always leading the way. But it's not really feasible, accessible for small projects, and it doesn't make sense as well for everyone to build their own infrastructure. So economies of scale are achievable if you delegate that task to a smaller subset of players. And we're already starting to see this happen with I'll take the case of Angle. So Angle is the creator of AG Euro, which is a decentralized euro stablecoin. And they recently started accepting Bakkt tokens as collateral, focusing on the fixed income ones. But so they basically transferred the burden of connecting to traditional finance to a third party, in that case, us, Bakkt. It also, that way they reduce their legal exposure, and they're able to better focus on what they do best, which is build great DeFi products. So here is a chart by our friends at Steakhouse showing the growth of those tokenized assets. Maybe we could even, like, those numbers could even include Franklin Templeton and make it, I think, close to $750 billion. But it's exciting to see this growth, but the numbers are still quite small in comparison to traditional finance. And the potential for growth obviously is very large. It's potentially even larger than what crypto is today. Fundamentally, I think we all believe that crypto rails are better suited for financial transactions, and eventually all financial assets could migrate on-chain. So there's about, probably at this stage, a dozen issuers of tokenized traditional assets, with more to come. And they all took different approaches. They all look the same in the sense, like, when you're considering UST bills, that they're offering a product which yields about 5%. But yeah, their approach is quite different. Most are choosing the permissioned way. We've gone with permissionless assets. There's whitelist, blacklist, different legal framework, US laws, German BaFin, Liechtenstein, Swiss DLT Act. And there's no right or wrong approach. It's more a question of trade-offs. Which customers are you trying to serve? Is it, are you trying to cater for US customers or the rest of the world? Do you want those assets to live in a gated environment or fuel DeFi? And that dictates, what kind of approach each issuer takes. So technical challenges, I'll speak about ourselves, but yeah, the hard part in tokenizing traditional assets is interfacing with traditional finance, which runs on archaic systems. Crypto settles instantly. TradFi securities usually settle T+2. That means that cash and securities are exchanged 2 days after a trade is agreed. But even when you think about like a simple wire, we send wires, every day for our operations, and you never know if it's going to land the same day, the next day, 3 days after, So there's issues there, and for us it causes troubles, with our user experience. There's crypto people that obviously want to get their tokens instantly, and that implies that we need to provide our own working capital and bridge the two systems. That difference in settlement, is also an issue when we're trying to integrate proof of reserve products. So we'll soon have Chainlink's POR product, where they basically connect to our custodian bank, and they're able to read the values there and make it available for everyone on chain. But the client comes in, sends USDC, those securities land our accounts 2 days after. So we have to find a way to bridge that again. Again, for us, other technical challenges was building or integrating with a myriad of traditional finance providers, on-ramp, off-ramp services, securities brokers, securities custodian, a security agent, which looks at our operations and makes sure that everything is in line. And connecting with each and every one of these is quite hard. When we back last year, we were about to release our first product, and our original custodian basically rugged us, and they were going for a full banking license, and they decided to stop supporting our business. So again, we had to find another custodian, and now we're obviously trying to make sure that we have redundancy at all these layers, and that's quite hard. But probably the most challenging is obviously regulation. It took us about 2 years to refine the setup. So we're based in Switzerland. We leverage a favorable regulatory framework. But even today, we still have to strengthen that position by incorporating new issuer entities in different jurisdictions to make sure that, again, we have redundancy and we're able to arbitrage the different jurisdictions together. So in terms of how our products are built, we chose, some of our competitors chose the fund model, but we went for a structured products approach, whereby tokens are ownership of those structured products, which effectively track an underlying asset, with those underlying assets being held at a custodian. In our case, it's a Swiss bank. So even today, we've solved it on the issuance side, but we're hitting a wall when it comes to secondary markets. So the token we've chosen, and our inspiration at Bakkt was very much Circle in the way they operate. Namely, they have a primary market where you have to onboard to actually be able to create and redeem those tokens. But then we issue, in the case of Ethereum, we issue ERC20 tokens. They're freely transferable. But today we're, even though we've had a bunch of these tokens issued, we're kind of hitting a wall in the secondary market and bootstrapping those markets. Because with securities, there are added rules and regulations and licenses that one needs to hold to be able to offer those products to retail. So even though we built the products so that they're bearer assets and they can be transferred freely, we're considering to restrict that transferability to create a safe bubble, a safe place for that liquidity to emerge. So I'm going to disappoint you and say that there's no way, and I don't think it will be possible even in the future, for these assets to be issued in a decentralized manner. So when you're interfacing with traditional finance, it requires centralization. But there's things that can be done in the spirit of decentralization. So I'll speak about two projects that have already integrated backed tokens. First one was actually Ribbon. So Ribbon relaunched their Earn product, which is a vault offering its users a yield and exposure to Ethereum. And Angle is that Euro decentralized stablecoin, which I was speaking about before. And both have started accepting backed tokens as collateral. And we're seeing a play whereby Ribbon, which has this vault and is offering is backing and generating the yield with backed UST bill product, actually looking to go and deposit those tokens at Angle to borrow AG Euro, basically effectively leveraging themselves and buying more of these UST bill products. And that's a clear case of interoperability and efficiency, and which is where DeFi shines and outperforms traditional finance. It even works in the case of traditional assets. Thanks very much.
And we have time for questions. Just raise your hand if you'd like to ask.
Yes. Thanks a lot for the talk. Real world assets are great and super important. When I looked at your products, I saw that backed tokens are freely transferable, correct? And at the same time, I saw that on-chain liquidity is basically zero.
Correct.
Why? Why is that the case?
So as was mentioning is that for institutions to provide liquidity on these assets, on securities, you need licenses, you need to have broker-dealer licenses to be able to offer those securities to retail. And with DeFi, the way it is, well, that's not really possible. Like you can't even know with whom you're trading. And so that's where, and the reason why we're considering restricting transferability so that we can create a safer place for these institutions and for liquidity to emerge. So that other protocols, just like Ribbon or Angle, can tap into that liquidity.
Okay, I see. Thank you.
Thank you. In terms of real-world assets that are the easiest to tokenize, what's the low-hanging fruit in the space? Because obviously it's very difficult with any real-world asset. There's obviously assets that you'd probably want to tokenize first, like bonds. But in terms of what is the easiest way to start this process, where would you go outside of bonds?
So I was going to say UST bills. Obviously, it's showing clear demand, clear market fit. I mean, we're gonna tokenize different asset classes. Well, we've got products in the equity space, fixed income as well, but we'll go into commodity, real estate. And for each of those asset classes, let's say fixed income, we'll tokenize as well products in the euro currency, dollar, JPY, JBP, from different issuers, governments, corporates, different duration, short end, long end, just bringing a really wide area of products to for users to be able to manage their wealth effectively. I think, yeah, as I said, like fixed income is definitely the best place to start with. What comes next? I mean, crypto is still a very retail market, so you could think that equities, which appeals quite a lot to retail, would be another good place to emerge next.
Yeah, sorry. I just meant in terms of what is easy when it comes to dealing with like TradFi institutions in order to make this actually possible. So for example, if you're looking at the fixed income space, dealing with the US government regulation in order to be able to take custody and then tokenize T-bills is one thing. You know, is it easier, for example, to do this in Japan with Japanese government bonds? Or is it easier to try and do this in real estate? Rather than focusing on what retail wants, in terms of just what would be the easiest way to get something to market, is there an asset class that stands out?
Not really in the terms of like technicalities. Like for us, it's the same level of burden to actually tokenize the S&P 500, and it's not. It's an ETF by iShares issued in Ireland that we tokenize. It would be the same burden to actually go and offer the Eurostoxx 50, for example, index. So no, we built something that's quite scalable, and it's just a different asset that we back our product with. But the regulatory burden is more on the at least for now, is more on the offering side, and it doesn't really matter if it's if that security is composed of U.S. assets or Europeans or
All right, thanks. Give Erwan a hand.